Housing prices are incredibly high, and on top of that, interest rates are going up very, very fast. If you're looking to buy a house or an apartment in today's market, you'd better not wait too long. And as always, our younger generation looking for their own first place to stay gets left behind, having to pay more and more and not being able to find funding for their first property. Luckily, here at the Money Network, we keep a close look at the financial markets, at the financial variables, and we can see market change very quickly. If you want to keep up to date with the financial markets and real estate investment opportunities, you should join the Money Network today. In this video, we will look at the current situation, and at the end of the video, I will share some tips to shield yourself against the ever-climbing prices. I will also share a strategy to buy your own home as soon as possible. So let's get right into it. What's up everyone, my name is Joris and welcome back to the Money Network. As you might have noticed, interest rates are climbing very fast. The consumer price index in the USA has been rising from 2.6% up to 8.5% all in the span of one single year, with a boost of 1.2% in February. This one-year rise is the biggest surge in the last 40 years. This huge boost in inflation, which hopefully will top out soon and start going back to acceptable levels, it will have an effect on the interest rates. To combat high inflation levels, central banks have a lot of tools in their arsenal, one of which are the controlled interest rate hikes. In very simple terms, if the central bank raises interest rates, banks will also have to raise their interest rates, which will ultimately result in a higher interest rate when you are lending money or when you're taking out a mortgage. This in turn will have a consequence on the buying power of our younger generation. So let me clarify this further. If your bank allows you to pay 1,000 euros every month for 25 years at an interest rate of 1%, you are able to lend up to 265,000 euros. But if interest rates rise and your mortgage interest rate goes up a percentage, it goes up to 2%, your bank won't simply allow you to pay more every month. No, they want to keep their risk in check. They will limit you to that 1,000 euros monthly, and that is fixed. And when their interest rates go to 2%, for example, banks will allow you to only lend 236,000 euros. That is a 1% rise in interest rates and 30,000 euros less in loan money. As you can see, higher interest rates lead to lower principal loans. And since the younger generation relies on these big loans to be able to buy their first house, they will be the first to drop out of the potential buyers pool on the real estate market. So does this mean that the real estate market is due to a correction and prices will drop soon? Well, not per se. Investors will come back to real estate pretty soon. With higher inflation, the stock market is also more volatile and less predictable. At this point, investors will turn their attention towards the real estate market and they will buy houses without loans if necessary. I'm afraid that the real estate market will not see a crash anytime soon. However, the real estate market might cool down a bit and maybe drop a few percentages. And this wouldn't be that surprising, seeing the incredible rise the last few years. But a full-blown crash, that's not likely. Unless interest rates would hike to incredible heights in a very short period of time. If, let's say, interest rates shoot up from 1 to 5% overnight, this will have a huge impact on real estate. But this is highly unlikely because it would most definitely put us in a deep recession as well. Something the central banks are trying to avoid at all costs. In the past, we have seen dramatic mortgage rate increases, but they have not per se led to crashes in real estate. On the contrary, they supported the housing market. So, if you are young and you are saving for a house, what should you do next? You have to understand that higher inflation will also mean that your average living costs will go up. If you are not paying attention in the next few months or even years, you will be losing out on a lot of money. You might even create a financial hole that will take years or even decades to fill in. So here are some tips to keep in mind at all times. First off, just stay calm. It's not the end of the world. Yes, inflation means that there will be higher prices, but that doesn't per se mean that you have to spend your whole monthly wages on gasoline or on toilet paper. So just stay calm and take it easy. Let's see where this goes. Secondly, if you haven't started already, now is really the time to start budgeting. An inflation level of 5% means that your grocery bill will raise by 5% in the span of 1 year. A shopping cart worth 100 euros today will cost you 105 euros next year by buying the same exact items. If you then start a budget and only buy things you really need, you will still be hit with inflation, so make sure that you're not paying inflation on items that you don't need in the first place. Set out a certain budget, look for promotions and coupons, and be smart with your money. And this brings us to the third tip. Try to save money wherever possible. Look for cheaper alternatives for your essentials. Go to work by bike instead of the car. Walk instead of taking the bus. Or buy alternative groceries that have the same quality but maybe are not from the known brands. Buy in bulk if you find good deals and don't buy any useless items. And then the fourth tip, the last thing, invest your money. I cannot stress this enough. Yes, inflation is a thing, but you can use it to your advantage as well. If overall prices go up, sale prices of companies will also go up. Profits will rise and stock prices will follow. When you are invested in stocks, you are bound to make a profit over time. But remember, in the stock market, you make money at a very slow pace. On the other hand, a bad investment will make you lose money very fast. So always make sure that you are invested in a global and diversified fund. But before you even start investing at all, make sure that your overall finances are in order. Make sure that you have an emergency fund. Pay off any other debt with high interest rates. Apart from mortgage rates, that is debatable. Only invest with money that you won't need in the next few years. And this again brings us to our original question: to invest money or to save up for real estate. Maybe with higher interest rates, it is now time to consider renting instead of buying. I can definitely understand the appeal of renting instead of buying. You are a lot more flexible when you are renting. You have less responsibilities and frustrations, and you can always change locations when you want. Make good decisions and don't decide on a whim. Don't worry too much, take your time. If today is not the day to buy real estate, just leave it be for a while. Take your time to save money, invest a bit if it's possible, but don't do anything without thinking. You'll regret it later if you do. It's better to wait a few years than just buy something right away. The high inflation rate, the high interest rate on your loan will make sure that you lose a lot of money. So please just wait, interest rates will go down again. Make sure that you are financially stable and then, only then, consider buying a real estate. So, what is your plan? Are you still looking for real estate or are you now considering renting? Let us know in the comments below. If you have enjoyed this video and you have learned something, please leave a like for the YouTube algorithm. Subscribe to the channel to support our growth and share the channel with a friend. We thank you very much for watching and we'll see you next time.